What's going on, dividend chasers? It's the Dividend Bloodhound here with another investing episode. In this episode we're going to be talking about US based, or listed in the US stock market at least, dividend growth stocks. Now this is a really important subject for your long-term investing strategy and portfolio, because what you want to happen is your dividends will grow over time each year, a little percentage at a time each year, gradually increasing the amount and the yield that you have against the original price that you paid against buying the share in the first place. And that is really important. In this video today I'm going to talk about some companies that are going above and beyond what would usually be expected in terms of dividend growth, and hopefully you can in turn look at these for your investing portfolio. That being said, if this video adds value to you and you enjoy the video, please smash that like button in the corner, or if you're new around here, please subscribe to my channel. It would be great to have you around here. We really like getting investing information out to the masses, and that is what we're all about. Today we're going to cover Visa, MasterCard and American Express in this part of the video. In the next part of the video we will cover some more growth stocks such as AbbVie, JP Morgan Chase, BlackRock and Caterpillar. Caterpillar you might not expect to be on there, but it has been growing its dividend consistently for 25 years. So I've decided to include it as a little bit of a curveball and something that's not actually in the financial field for once, as well as AbbVie. That being said, let's get into the analysis of the first few stocks in this video. Catch you on the other side. What's going on, guys? Thank you for joining me in the next part of this video. As you can see, I've already lined up the stocks that we're going to talk about, but this video will be split into two separate parts and I will upload them on different dates. Please bear with some of the price changes in this video because I'm going to film them both today, but there might be some slight discrepancy between what price they are in this video and then what price they are on the date that you might actually watch it. The first one is going to be released today, but the second one will be released in a few days' time. But thank you for joining me in this next part of the video. So first up we're going to talk about Visa. Visa is a payments facilitating company that has been around for a considerable, almost since the birth of the card payments itself. This company has been around for and is really starting to get a foothold in the market now as the company, as the world goes towards a cashless society and pays for everything on cards. Now this little introduction sort of applies to all of the companies that I'm going to talk about in this first part of the video. So Visa, MasterCard and American Express are all benefiting from the society switching to cashless, basically, or slowly but surely switching to more and more card payments or transactions online over time. That being said, let's get into the first little bit of analysis in this video. So Visa is the first company up. Its ticker is V. It has a market cap of $364 billion. It has a PE ratio of 31. Its revenue is 22.98 billion. Its EPS is 5.46 and a nice dividend yield of 0.71. I'll get into it. I'll explain why this is important in a little bit. It has a net income of $12 billion, so lots of money left over in terms of profit. And then it has been growing its dividends for at least 12 years. I found this out of Seeking Alpha. However, what I will show you here is its 3-year dividend growth at the bottom here has been 21% over the last 3 years. Now that is an insane insane amount of growth. So that 0.7% that you originally saw there, if the longer you own this stock with growth rates like that at 21% over 3 years, you are going to be flying along with the dividend growth side of things, and that will build into a considerable amount of money over the near future. As you can see there, Visa is a fantastic company to own. It is the largest card provider in the world, and instantly one of the largest in the world, should I say, and instantly recognisable as such. It has the turnover and the profit to go with it, and I almost guarantee if you're watching this video and you go and have a look in your wallet, at least one of your cards will have the Visa logo on it. They facilitate absolutely every payment made by card or made by a transaction with any sort of Visa facility. They've helped facilitate that transaction, and that is really important going forward and going to the future, because we are moving towards a cashless society. That being said, let's get on with the next stock, which is MasterCard. I'll see you back in there. Hello again, guys. Yes, MasterCard. This is what we are moving on to next, and largely what I said for Visa applies pretty much to MasterCard. These two have a duopoly, really, or a trilogy with MasterCard, but these two are the, not MasterCard, with American Express, but these two are the big heavyweights, as you can see, with the turnover and the price of a share. MasterCard is exactly the same as, or facilitates exactly the same as Visa, really. And I will just take you through its fundamentals now. So its ticker is MA, has a market cap of $258 billion, a PE ratio of 32.84, revenue of 16.88 billion, and a dividend yield very similar to Visa's of 0.62%. It is trading today at $247 a share, has been right up to highs of 344 and down to lows of 212. I will just quickly go back because I realise I just forgot this. We'll do the same for Visa. So Visa is trading today at $161 a share. It's been right up at $212, $213 in fact in the last year. And then it's been down recently because of the health crisis, as we have seen, all the way down into the 130s. So it is a great time to pick up these companies at the moment, I would say, in my opinion, and that is why they all feature in my portfolio. And yeah, just quickly back onto MasterCard. So it has been growing its dividend for 8 years, and its actual dividend growth over the last 3 years has been 20.2%. So very similar growth to MasterCard, which is why I believe these play such a vital part in your portfolio for the very long term. That rounds off MasterCard there just nicely. Again, you will find this card, if your bank doesn't use it, your credit card probably will, or you will have put a transaction, you will have used a transaction that has MasterCard attached to it. Both of these companies are dominant all the way across the United States and most of Europe as well. I'm not aware of seeing any other card provider in the UK apart from these big three heavyweights that I'm covering in this video. And I think to take advantage of that in your portfolio, having these big three trio, taking advantage of all the card transactions across basically the United States, probably Canada and Europe, is a really big weight to have in your portfolio for the future. I think you'll find most dividend investors will have at least one of these in their portfolio. That being said, let's move on into the next stock, which is Amex or American Express, and I'll catch you back in there. Thanks again for rejoining me, guys, in the third part of this video. In this little bit we're going to cover American Express. Again, another heavyweight in the credit card industry, a bit smaller than the other two like gigantic ones we've covered, Visa and MasterCard, but still a hefty turnover, as you will see, which makes this company a very strong asset to have in your portfolio, and actually has a slightly higher dividend yield, as we'll come on to see as well. So its ticker is AXP. It has a market cap of 70.42 billion, a PE ratio of 10.94, revenue of 45 billion, EPS of, as near as makes no difference, $8, a yield of 1.97, so 3 times as high as either Visa or MasterCard, and has a net income of 6.76 billion, which is a little bit lower than the other two, as you would imagine, but not massively lower, and your actual yield is far higher. This company is trading today at $81 per share. Started off at $136 in February this year, before the crisis crashed the market, and then it went all the way down to $69 a share at one stage, which is roughly when I bought a share of this company, completing my trio of global global financial services providers. All three of them pretty much do a very similar thing. Now, their dividend growth has been up, is also hence why we're doing this video, has been very high. Not quite as high as Visa and MasterCard, but you do get a higher yield to start with. This one, its 3 years growth has been averagely 10.36% or 37%, sorry. That is still a hefty percentile increase to your income each year. It's essentially like a big pay rise each year, and you're already starting off at as near as makes no difference 2% yield. So for them to carry on going down this route, if you hold this stock in the long term, that is going to work out very well for you indeed. Now, that being said, that wraps us up for these 3 heavyweight financial facilitators. I'll see you back out in the real world. Catch you in a second. You're still here. Fantastic. Thank you for having the endurance to stick to the end of this video. I really appreciate it, and I really appreciate the watch time that you're providing to this channel. And that is the most important thing for me now, as I've moved past the 1,000 subscribers side of things. It is now about getting the 4,000 hours of watch time. I really appreciate you sticking around to the end of this video. To wrap up, we have covered Visa, MasterCard and American Express in this video. My trio of card providing, financial service providing companies that are growing their dividends at a massive rate. We have 2 that are over 20%, and then American Express bringing up the rear with a 10% growth over 3 years. But American Express does grow, is starting with a 2% yield, whereas the other 2 are starting at 0.7 and 0.6 respectively. All 3 of these companies are significantly beaten up by the health crisis at the moment, and you could easily make plenty of money just by buying these stocks now and holding on to them for the long term and maybe selling them at a later rate. This is not me recommending that you buy these stocks. Please do your own research to do that. This is my own opinion, and these 3 are forming the trilogy in my portfolio. I already have them, and they are forming part of my long-term strategy to grow my dividends at a really high rate. And I hope to add to these in the future and take advantage of this crisis and buy some more while they're at a much reduced rate. That being said, I'll catch you in the second part of this video, hopefully, where I'll be covering a few more financial companies, but also some a pharmaceutical company and a industrial company, just to broaden the diversity really, instead of just covering purely financials, even though it seems that financial companies are the ones that grow their dividends most. That being said, I'll see you in the next video. Goodbye.